Let's start today I'm looking back about 6 months, Austin. I do occasionally read the broadsheets, and in all the money sections, in all the finance sections, that they're telling us, don't worry if you've invested heavily in the stock market. You may have lost hundreds of thousands of pounds, but you're in it for the long term, and it will get better. Now, of course, we all want it to get better.
Yes.
We all hope it's going to get better. Is that the sensible option? Should we just stick with it?
Well, I think it really depends upon your time horizon. In the press, you get this conventional wisdom about if the stock market goes down, that you should do nothing, you should hold tight and not rock the boat. But my view on that would be, well, who does that really serve? Does that serve the interest of the person that's saying that, or the fund manager that's saying that? Because there appears to be this self-interest that you should always do nothing. And I think that's a little bit arrogant of the wealth management industry, because they don't really know what a person's timescales are, what their exit strategy is. And so what we really need to do is to look at things on a more individual basis. And personally, I believe that actually doing nothing is not an option.
Okay, so if you're, for example, in your early 50s, you're looking to retire 55, 60, so you're looking maximum 10 years. I would assume, from what I've read, again, well, 10 years, that's fine. So you're saying, no, maybe you should pull out and do something else.
There is this rethinking of what is what we call efficient market theory. Because, slightly technical term, but what it means is that there is this sort of cult of the equity, the conventional wisdom that you must always invest in shares, you must always hold them for the long term. But actually, it doesn't always work, and the reason we know it definitely doesn't work is just by looking back over the last 10 years it hasn't worked. So if you...
But these ideas have been in place for about 40 years.
They have been, and they've gone back even further and looked back some recent research that came out that looked if you'd invested in stocks or bonds almost 40 years ago, and actually there's very little difference, and in some time frames actually bonds do better than shares. There was a recent article in the Financial Times that said that a lot of very heavyweight economists are now having to review what they teach, because actually what's been taught over the last 40 years may actually have to be readjusted, because whilst shares are good for the long term in conventional wisdom, in reality they're good for short bursts. So they're good for short bursts of maybe 3 to 5 years, then you take stock and then you readjust and then you maybe take profits, etc., etc. There's a very old-fashioned saying that a profit's not a profit until it's taken, and what people forget to do is they forget to take their profits in the good times, because the good times don't last forever.
It's going to be very difficult, though, to work out when to take things out and when to reinvest. So again, it's not just a guessing game. You're going to have to watch the market. So as far as Austin James Consulting is concerned, because you are quite a small company, you can be quite hands-on with your clients. Is it still a risk for you when to take things out and put it back in again?
Yeah, we don't profess to have a crystal ball to know what's going to happen in the future. What we do is we sit down with clients on a regular basis and simply have these discussions with them. We show them graphs of the stock market. We say, look, this has happened in history before at various times when we've had similar situations like this. What would you rather do? So we haven't been sort of saying to clients that they must be out of the market completely. Last year, during 2008, the markets were becoming a bit of a casino. They were behaving completely irrationally. Now, you then sort of say to a client, well, you know, are you an investor or a speculator? Because last year it was pure speculation. The market was moved by psychology, and I think a lot of people have forgotten that there's only two factors that move markets. One is fear and the other one's greed. And we had fear moving the market last year. It became a psychological market. Economic fundamentals don't work when everyone's fearful. And so for some clients it was the best course of action to actually move their assets into cash or to lower risk asset classes such as fixed interest and bonds, because of their time horizon. So coming back to your question about, well, what do you do if you've only got 5 to 10 years to go, I think you do have to urge on the side of caution, because we must never forget that it's our clients' money. They have to sleep at night. And I think if there is criticism that's come out of my profession over the last few years, is that some elements of the profession have become a little bit too arrogant in prescribing that people must stay in for the long term, even taking 30 to 40% losses in the interim. And I think that's very dangerous to do that.
Okay, well, let's round off with if someone wants to come and talk to you because they have lost a large amount of money with a larger organisation, is it something that you would be able to talk to them about and maybe encourage them to come to Austin James Consulting? Just because you are a smaller company, would they have to just accept that loss and almost start again? Is that effectively?
No, not necessarily, and there's a misconception. I mean, first of all, we're not going to change anything.
No.
Not necessarily, we're just simply going to review things. Because what we find is a lot of people actually don't understand the level of risk that they're taking.
Well, that's exactly.
And they don't understand what they've actually got, which is why when they see that their money's lost 30–40%, it's more of a shock to the system. And so we help them understand the level of risk that they're taking and that could perhaps be realigned. Now, that doesn't mean that they're going to crystallise those losses and forever have those losses. It simply means that you have to pause for breath and then gradually drip feed back into the market in a more balanced way to actually achieve your long-term objectives.
Okay, thank you very much.